Hey everyone, and welcome to my channel. Today we're diving into two topics that sound similar, but in reality, they are significantly different. I'm talking about APR and APY. Initially, these rates might seem tricky, but are crucial to you managing your money successfully. You might have seen this on your credit card disclosures or heard of high yield savings accounts that pay between 4 to 5%. Let's talk about the basics. APR is the cost of borrowing money, while APY deals with the potential increases in your money. It doesn't just include the interest rate, but it also includes the extra fees and costs associated with getting a loan or a credit card. So we talked about APR being the cost of borrowing money. What I did mention is that APR stands for annual percentage rate. Let's just say you decided to get a loan for $1,000 with an APR of 6%. A standard loan with an APR of 6%, you see you paying $1,060 by the end of the year. So now let's talk about APY. APY stands for annual percentage yield. This is all about growing your money. With APY, interest compounds. And compound interest is what makes APY stand out from APR. What does that mean? As I mentioned before, with APY, what you earn stack piles on what you earned the prior month or the year before. So unlike APR, APY is like going to the ice cream shop and getting extra scoops just because you showed up. And of course, if you're looking at savings accounts, APY is crucial to understanding how much you're going to get for your return over time. Let's use the same $1,000 as an example for APY. You take $1,000, you decide to give it to the bank. The bank says, hey, we're going to pay you 5%. Based on the agreement that you make with the bank, you wouldn't just make $1,000, $1,050. What would happen is, with that interest, it will compound over each cycle. So if it's a monthly agreement that you made with the bank, every month, interest will stockpile on top of interest. So I just did a mouthful about APR and APY. So what's the real difference? A high APR is obviously bad for you. Conversely, you can see that a high APY can be great for you, factoring in compound interest, because you will yield more over time. Pro tip, during times of inflation, you'll see interest rates go up on savings. So to encourage savings for consumers. So in other words, economists use savings rates to gauge the financial health of consumers in the market. So there you have it, APR and APY. Pay attention to APR when you're getting a loan or a credit card, or you might regret it. Think about APY when you're getting a savings account or an investment, because this would be really beneficial.